Hello everyone. Our debate topic today is in 2025, an evidence that buying residential property provides better retirement outcomes than a high growth super fund. On the affirmative side, I will argue that residential property offers stronger long-term growth and income stability for retirees. My first argument is residential property delivers higher long-term growth than sales. Over the past 2 decades, Australian residential property has outperformed equities in terms of long-term capital growth. CoreLogic data shows that Sydney house price increased by an average of 6 to 7% between 2000 and 2023, while the ASX 200 delivered only around 4 to 5% per year over the same period. Even during crisis, housing has proven more resilient. In the global financial crisis in 2008, the ASX 200 lost nearly 40% of its value in just 12 months, whereas Sydney house price fell only about 7% before rebounding within 2 years. Following the COVID-19 downturn, dwelling values surged by more than 20% between 2020 and 2022, significantly outpacing the share market recovery. This demonstrates that residential property not only carries lower downside risk but also delivers strong long-term capital growth than equities, making it a superior asset for retirement planning. Secondly, I believe that rental yields are steadier and often stronger than dividends. According to CoreLogic, gross rental yields in Australia average 3.5 to 4.2 percent nationally, reaching 4.5 to 5% in supply-constrained markets such as in Sydney and Brisbane. Between 2022 and 2024, rents in many urban areas rose by 10 to 15% annually, showing rental income ability to track inflation. By contrast, dividend yields on Australian equity average around 4%, but a high-growth super fund heavily weighted toward international equity typically delivers only 2 to 3%. Dividends are also discretionary. Companies often cut the suspend in them in downturns, whereas rental demand is tied to the fundamental human need for housing.
Thank you. So the affirmative team argues that residential property offers better long-term growth and more stable income than shares. But that argument relies on selective historical data and ignores the financial realities of 2025. Yes, poverty grew impressively in the early 2000s, but we aren't investing in 2004. We are investing now, and the numbers tell a very different story. So according to AFR modeling, someone with a 400,000 super balance who buys an 800,000 property through an SMSF would retire at 55 with just 1.68 million. Meanwhile, staying in a high growth super fund delivers more than 2 million, and the gear super fund earns 2.68 million. That's a 340,000 even under optimistic assumptions. So now let's stress rental income. The other side claims rent is more reliable than dividend, but they are comparing gross rental yields to net investment returns, which is misleading. Rental income might look stable, but it comes with healthy costs. Mortgage interest at 6.5% to 7%, property management, repairs, insurance, and tax rates. And don't forget SMSA admin fees. Once you factor all that in, the net rental yield often drop below 2%. And here's the practical problems. You can't sell one bedroom to pay your electricity bill. Superfund give retire liquidity and flexibility, which is critical for real-world outcomes. So now let's move beyond rebuttal. Even if we set performance aside, SMS are still the riskier and less practical options for most Australians. Modeling shows SMS using residential property underperforms, and national data back it up. Australians are voting with their wallets, choosing high growth APR and regulated super funds that now hold 3 trillions of the 4.3 trillions in super assets. Despite the hype, SMF remain a small share because APRA funds deliver stronger and more consistent returns. The slow growth of SMSF assessed assigns underperformance and weaker investor confidence. If property strategy in SMSF really work, we see the opposite trend. But the data say otherwise. With limited tax benefits and a flat 15% rates, negative gearing inside SMSF offers little rewards for the same debt and risk. So by contrast, high-growth super funds already delivered strong return, broader diversifications, and low relative costs. For example, in FY 2024, the median gross super fund returned 11.4% net of fee, with share markets performing so strongly in 2024, particularly international shares. It is not surprising that the super funds that are allocated more to shares, particularly international ones, and generally delivered better returns. Um, Otherwise, funds heavily invest in low-growth assets like property, cash, or bond underperform, while greater foreign currency exposure boosts returns as a AUD weakened. In 2024 to 25, Australian super's balanced option returned 8.46%, choice income 9.25%, and high growth about 10.61%. So this return, achieved with diversified portfolios, underscore the high crucible funds are capable of delivering consistent risk-adjusted performance without the concentration, costs, and risks for single property SMSF approach.
Hi, my name is Tai Zhuang, and I am going to represent the second speaker for the affirmative team. Um, let's get straight to the point. So, first of all, I am going to reboot the first negative speaker. Me personally, I don't think that their numbers don't fit 2025 anymore. Today, SMSF loans are around 6 to 7%, and rentals are tight, with the leverage around 60 to 70% in higher yield suburbs. Total return is rent plus growth, not growth alone. Rent actually helps to pay the loan, meanwhile, dividends in a pool fund don't. So compare like for like 2025 rates, 2025 rent, real cost, and a specific asset, not average bill to fail. Furthermore, an SMSF isn't a one asset bet. You can hold cash, ETFs, as well as bonds alongside one property and keep cash buffers. RLBA is limited resource only. The property is on the hook, not the rest of the fund. That risk contained plus member control, where to buy, who to list, when to exit. Now, moving on to my point. This is my first point that relate to the leverage advantage of SMSF. So an SMSF lets me use member-directed leverage PR RLBA with the rate of 6 to 7% and leverage about 60 to 70% as mentioned before. A 1% price rise is amplified on my equity. Rent helps cover interest and holding costs. Meanwhile, pool dividends don't service debt. This year, the RLBA safe harbor fell from 8.5% from 9.35%, so the cost of capital is lower. And furthermore, the LRBA is limited resources only, so is secure the property is at risk. And moving on to the next point, this is my second point of the about SMSF. That it gives you great flexibility and control over the assets. So you can choose what to buy, where to buy, who to lease to, and when to sell. Uh, in a pooled high growth option, the trustee decide that one. Member doesn't pick asset or the timing. And if the business real property, uh, I can lease to I can lease that one to my own business at market rates. That too doesn't exist in pooled funds. Furthermore, I can align the portfolio with my risk tolerance, my business needs, and my long-term plan. So SMSF property gives me controllable leverage and asset level control. That combination is how you build real world retirement outcomes, not just modeled average.
So following Dung's ideas about on the affirmative side, I'm on the negative side, will present my points below. The first thing is SMS loans are more expensive. As you can see, according to Money Smart, which is a source I put below there, the Australian government's own financial guidance website, buying property through an SMSF could involve extra costs, legal fees, stamp duty, maintenance, council rates, and annual audits, and also other extra fees as well. These ongoing costs eat into retirement savings every single year. Meanwhile, on the other hand, high growth super funds have lower management fees and don't require the member to personally pay up for audits and repairs. It also causes liquidity issues that probably ties up large amounts of capital, making it harder to access funds or for pensions or unexpected costs. So right from the start, the SMSF investor is running uphill just to cover their costs. The second thing I want to talk about is the SMSF loans are expensive and also are going with the riskier and concentrated. So the SMSF property loans known as LRBAs are treated as riskier by lenders. Saving.com's from the source has explained that these loans usually have interest rates higher around 1% than normal investment property loans. Finder and money.com.au also list current SMSF residential rate between 6.2 to 6.7% per annum in 2025 in this year, much higher than the standard investment loans. Which also caused to think the cash flow thing I want to talk about is that borrowing money to purchase the home means that your SMSF will have a less liquidity and cash flow. You may have to use the cash from fund to cover loan repayments, which could also become harder if the interest rate, just as I already said, rise. And also with diversification, as my teammate already indicated before, I just want to talk. I would talk shortly about this. That according to Money Smart, explains that diversification lower risk by spreading investment across different assets. High growth super funds therefore deliver a smoother and safer long-term returns. Since a single house means only one postcode, one tenant, and one market cycle. So, with my friend points, the first one is about leverage advantage. My friend argues that SMSF has a leverage advantage, but leverage work both ways. It amplifies losses just as much as gains. Property market fluctuates. If price drops, the SMSF suffers a magnified loss while have to paying high interest. And remember, SMS loans are more expensive. Even the best deal are start at about 6%. So leverage is not an here is an advantage. It's a double-edged sword that increase both cost and risk. While the diversified high growth fund compounds with steadily without those. Second thing is flexibility and control. Control, my friend said that SMSF give more control, but control also means more responsibility, more paperwork, and more risks. SMS trustees must comply with strict ATO rules, the sole proposed test, arm's length leasing, and yearly audits. Money Smart highlights all these extra obligations, along with the added costs of running an SMSF property. Mistakes can trigger penalties for non-compliance, which no investors want before retirement. In contrast, a high-growth super fund is professionally managed, fully diversified, and low fee, no stress, no paperwork. So to conclude, the evidence is pretty clear that SMS are probably expensive, risky, and difficult to manage, while high-growth super funds are cheaper, diversified, and consistently deliver better retirement outcomes. That's why we reject the motion. Thank you.
Now I'm back to make a rebuttal about the arguments of the negative side. First, on cost, running an SNFS breakdown include fees, but the ATO 2025 report shows the average cost is only 0.5 to 1% of total assets, similar to high growth fund fees of 0.7 to 1%. The key difference is that SNS costs are fixed, while retail fund fees increase with balance, making SNS cheaper long term. Those fees also by control flexibility and real asset ownership. Second, on loan costs. Yes, LMS loans are slightly higher from 6.2 to 6.7% according to savings, but they are offset by rental yields of 4 to 5% and capital growth of 5 to 6%. That a total return of 8 to 10% per year, clearly higher than the loan rate. And with the RBI expected to cut rates later in 2025, borrowing will only get cheaper. Third, on risk. Owning one property doesn't mean poor diversification. Many SNSs also hold FTS and cash, and the property market itself is strong. Vacancy rates are just 1 to 2%, and Australia faces a shortage of 75,000 dwellings by 2029. That's not a high risk, that is high demand. And so that is the end of our topic. Thank you for watching and listening.